You own 60% of an Indian company. You live in Dubai. You think your tax exposure is just TDS on your salary. Well, here are the 4 things you are missing. Welcome to this explainer. Today, we're taking a really hard look at the cross-border regulatory reality for non-resident Indian entrepreneurs. Listen, the scenario I just laid out, it's incredibly common. You've moved to the UAE, you're loving the lifestyle, you're managing your Indian business remotely, and you're kind of just assuming that, hey, since I'm a non-resident, my Indian tax footprint is basically minimal, right? Well, the Income Tax Department and the Reserve Bank of India, they see things very differently. We're going to rapid fire through the 4 massive tax and regulatory exposures most Dubai-based NRIs are completely blind to. Ready? PE risk, the deemed dividend trap on company loans, dividend TDS without a DTAA claim, and finally, the FEMA reporting gap. Okay, let's just dive right into trap number 1, permanent establishment risk. A lot of founders think that just because their company is incorporated in India and their Dubai entity is totally separate, the lines are perfectly drawn. But tax authorities, they look at substance over form. It's like a giant puzzle to them. The law defines a fixed place of business super broadly. In fact, the Supreme Court of India in the landmark Strategic Oversight Services case really hit the nail on the head here. They ruled that a PE is determined by your degree of substantive control. So if you're sitting in your gorgeous Dubai home office, exercising continuous control over your Indian unit, making staffing decisions, policy choices, financial oversight, you could accidentally create a taxable permanent establishment in India. And there's no way around it. The profits attributed to that PE are now taxed independently in India, even if your parent entity abroad is literally losing money. But hey, it's not all doom and gloom. Budget 2026 actually threw us a lifeline with the new temporal test. It's a clear safe harbor. If your remote work is less than 50% of a 12-month period, you're generally safe. So if you're a director working from your Dubai home office for less than half the year, that location doesn't automatically create a fixed place of business. But, and this is absolutely crucial, you need airtight documentation to prove it. We're talking location logs, crystal clear employment policies, and strict signing blackouts. Basically, you have to strictly refuse to execute global contracts while you are physically visiting India. All right, moving right along to trap number 2, the deemed dividend trap. This one is a real game changer, and honestly a true nightmare for closely held companies under Section 222E of the Income Tax Act. It's an aggressively punitive anti-evasion measure. If you own 60% of your Indian company, you are squarely in the crosshairs. See, there's this massive disconnect between how we entrepreneurs operate and how the taxman audits. You might look at your company's accounts and think, you know what, I'll just take a harmless cash advance from my private limited company to cover some personal expenses in Dubai. No big deal, I'll pay it back. That's what you see. But what the taxman sees, they see a company distributing accumulated profits to a majority shareholder without officially declaring a dividend just to dodge taxes. The law specifically says that any loan or advance to a shareholder with at least 10% voting power is instantly treated as a deemed dividend. And the financial impact? Absolutely devastating. Since it's a deemed dividend, you don't get the standard lower dividend tax rates. Nope. It is taxed at your massive marginal slab rates, which means 30% plus surcharges and cess. Actually, scratch that. It gets even worse. Because your Indian company gave you this money without deducting tax at source under Section 194, the company itself can be hit with a 100% penalty for TDS failure. So a simple 20 lakh rupee loan, that can literally turn into a multi-lakh tax demand that completely cripples your cash flow overnight. Okay, let's look at trap number 3, DTAA claims and all the savings you're leaving on the table. You moved to the UAE partly for the tax benefits, right? Of course you did. But are you actually claiming them correctly? 0%. That is exactly what your Indian tax rate should be on your UAE salary. Under Article 15 of the India-UAE Double Taxation Avoidance Agreement, or DTAA, if you are a tax resident of the UAE, meaning you're living there for over 183 days in a calendar year, your salary earned in the UAE is taxable only in your country of residence. And since the UAE has 0 personal income tax, your effective tax liability is 0. But here's the catch. You only get this if you structure your residency and employment contracts correctly from day 1. Now let's see how this compounds when we talk about dividends from your Indian company. By default, the Indian company is going to slap a 20% TDS on your payout, plus surcharge and cess. But under Article 10 of the India-UAE DTAA, the maximum tax rate on dividends is capped at just 10%. If you aren't actively claiming this, you are literally losing half of your potential tax savings. To actually unlock that 10% rate, you have to legally prove your residency. You need to get a tax residency certificate, a TRC, from the UAE Ministry of Finance, and then submit Form 10F online via the Indian income tax portal. No paperwork, no discount. It's that simple. Which brings us to our final trap. Trap 4, the FEMA gap. Now we're shifting gears away from the Income Tax Department and looking at the strict regulatory world of the Reserve Bank of India. The Foreign Exchange Management Act, FEMA, governs every single cross-border transaction involving foreign currency and non-resident entities. For an NRI entrepreneur, compliance here is absolutely not optional. A lot of founders think having solid legal agreements is enough. It's not. The RBI demands event-based reporting on incredibly rigid timelines. If your Indian company issues fresh shares to you as an NRI, you have exactly 30 days to file Form FCGPR. Buying or selling shares to a resident Indian, you have 60 days to file Form FCTRS. And every single year, by July 15th, without fail, you have to file the Foreign Liabilities and Assets return. It gives the RBI a complete snapshot of your cross-border ownership. Please do not underestimate FEMA. The RBI tracks all of this through their firm's portal, keeping an exact record of foreign ownership. If you miss these deadlines, or if your authorized dealer bank spots a discrepancy, well, you don't just get a polite warning email. Delayed reporting, incorrect valuations, or messing with pricing guidelines immediately triggers action from the Directorate of Enforcement. We are talking compounding penalties, frozen transactions, and severe legal headaches that can completely paralyze your ability to move capital between India and Dubai. So what is the bottom line of this explainer? Look, operating across the India-Dubai corridor is amazing. It offers incredible growth and tax advantages, but only if your compliance is absolutely bulletproof. You just can't rely on assumptions or some outdated advice. If you are an NRI director, you need to audit your permanent establishment risk, restructure those intercompany loans, claim your DTAA benefits, and lock down your FEMA filings. Do not leave your wealth exposed. DM me the word director right now, and let's get you set up with a free NRI business owner compliance check. Because ultimately, you have to ask yourself, is your current tax strategy actually legal, or have you just not been audited yet?